All right, ladies and gentlemen, I hope you had a wonderful day. I got another watch list for you, and the stock market just crashed. I know it sounds dramatic, but Jerome Powell came on today. He surprised the market with hawkish comments, and what it led to was the Fed futures pricing in 50 basis points at the March meeting to an almost certainty. The odds are sitting right below 70% right now. We started the week at 28%, but let me show you this a little bit. What you'll see, man, it was only a couple of weeks ago, beginning of February, this was a 0.4% chance of possibility happening. This is absolutely wild. Even the last time this happened here, and this is the first thing I want to show you, the only other time where the Fed futures jumped up 30% in one day, well, good old October 13th. So if you're not familiar, October 13th, that was the day the CPI came in super hot. We gapped down to 340, and then the market somehow, technically, we kind of bottomed since there. It was absolutely wild. So that could kind of be some of the good news if you're looking for some upside here. But now the big problem that I have is the events that we're getting moving forward and how the market is reacting, and even the willingness of the market to price in 75 basis points. We may have a problem because last time we had any sort of shock like that, it was around September, and sadly, it kind of looks like we're midway through September right now, and it's also correlating with Powell in front of Congress or a group of people making a statement. So, Chad, it was wild today. We had an extraordinary sell-off. The next couple of days are going to be very key. I got the breakdown for you. It's very simple. It's going to be all about the jobs report, but there's so much more to it. But if you've been watching over the last month or so, we keep bringing these Fed futures up, and I told you, once this kind of goes above 40%, that is going to highlight the market is uncertain. Pandora's box is open, and every data set between now and March 22nd, it has the possibility of moving us a lot. So, Chad, I got the plays for you. I got the keys. Everything else you're going to need. What you got to do is make sure you got the stamina and stay in the game and save that 10%. But it's game time, baby. Run it.
Walking to the couch, it's a 2020 election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson. I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down.
But right off the bat, I'm sure you're aware of it, but this just got very bad. It's not confirmed yet because we still have 2 weeks left, but the 50 basis points, it is now priced in at a certainty, and the problem that we have here now is if this goes any higher. So that's really going to be the theme of what we're talking about today, because obviously we have to be waiting for those data sets, and that's something you got to keep in mind here. These Fed futures move in, it is bad, and the market reacts violently, but sometimes there's a lot of delays, and it may look awful today, but even like we saw here in October, it could quickly go down about 2 weeks later. You could go from 40% odds back down to 12%. Same thing could happen here, and that is why the data is going to be so important. But what I mean about this getting worse is quite simply, this was a very low probability about 3-4 weeks ago. Now it's considered a certainty, but let's say the CPI and jobs data comes in really, really hot. Well, sadly now, if things get any worse, this number can go higher, and you may even start hearing people throw around 75 basis points because that's what they already did right when this started to happen. So that's what we got to look for. If the data confirms more hot job market or more CPI moving forward, higher inflation, then this is going to get awful. The markets are going to get awful. But now on the reverse, if you do get any sort of bounce in these bond repricing and you see it calm down, that can lead to a lot of upside. So that's your key there. Did I say a lot? I meant small upside. Small. It all depends. It all depends on Powell. But that is your first key. Coming into your second key now, we were talking about this yesterday in event risk. I really did not expect Powell to go about and start off hawkish. If you're not aware of what he said, the things that he said that were hawkish, he did not push back against inflation going up. And he actually said, yeah, inflation pressures are actually higher. It sounded like he thought it was going to go a lot higher, but this was all in the written statement. And that was just dramatically different than what a lot of people were expecting. And then on top of that, he said that the Fed funds rate, the terminal rate for the rates, he said it's going to be a lot higher than people are expecting. And surprisingly, that one wasn't the big one because the Fed futures are already pricing that. But compare that with him saying inflation pressures are coming back and that the terminal rate that they're going to set here in March is probably going to be higher. This was definitely a lot more hawkish than any Powell we've seen. But now after this event, like we were saying yesterday, he was most likely to not say anything because he could just leave it up to the data. Well, now he started off hawkish. The markets are responding. So now the next three events that we have, the jobs report on Friday, the CPI on Tuesday, and then Powell the Wednesday after that, the event risk just shot through the roof. If you thought non-farms was going to be crazy this week, it's going to be that much more crazier now because we're already responding, and then it's either solidifying 50 basis points and moving to 75, or the jobs report could kind of calm us down up until at least CPI. So that's the key about this now, is because every set of data can change the outcome, and this is going to mean volatility. So that's what we were talking about with the odds getting down to 50-50. The whole point is every data set is going to move this very, very wild, and that means we are going to have a lot more volatile outcomes from all of these events. So keep that one in mind. That is key number 2. And then finally, it's very simple, man. We just saw the markets go bad to good and now back to bad, more or less. We're still at those December levels, but the problem will be if this quickly turns into worse. So now we went from the market's awful, oh, wait, now it's good, no landing, soft landing, oh, wait, maybe that's not going to happen. But then if that turns into something worse, we are going to have a problem. And like I'm saying here, I think 380 on the SPY as a minimum would be likely, but that all depends on the next events and them turning ugly. But like I'm telling you here, my biggest fear is that this plays out like September or May, where you kind of have this sort of philosophy where things are bad, then everybody gets temporary relief, and then that changes really quick, and then you have another 3 months in the gulag till you do it all over again. But specifically August, September, that's where we really started to see that. So this is what I mean. Market was bad, then we got good, and now it's like we're getting back to bad. But the problem would be now is if inflation still stays up, rates are higher, a lot of people piled in, the bond rates are still much higher too on the long end. It just overall just leads to a gigantic problem. And now that 380 all the way down to that bottom level, that may be back in play. So like I'm telling you, this is all just happening today. This is day one. You shouldn't be too fearful of it. I still have most of the same plays, but what I'm trying to tell you here is that we are about to enter a lot of volatility, and we are looking over the edge, and things can change quickly. So if the data comes in not as hot, we don't have to worry about this. But if it does, well, we've seen this about like 4 or 5 other times last year, and it's going to get crazy. So I hope you're ready. But let us get into the plays. So, right off the bat, I got 3 different plays that I'm looking at. I did make a play on one of them here, and I'm going to start with this one. But NVIDIA, we were talking about it the last couple of weeks, and it would shoot up and down $20, $30. Well, I decided to go with the NVIDIA short. I think there's a lot of meat on the bone. The risk to reward is good. There is obviously the risk of them being an outperformer and squeezing from here, but they hit 238 again. They started to go up, and then they sold off, believe it or not. I think NVIDIA was actually a leader for most of the day. It was actually, wow, they were up to like their day before that highs. They were holding up good, and then the second half of dropping, they went down. Sadly, I felt like a schmuck. I shorted it here near the lows with 50 shares, but I figured I could scale up to 100 shares, or we ride it down, could probably catch maybe $20, $30 a share, and then worst case scenario, if you do get a squeeze, you're about like, what, $30, $40 from a 1-year high on them. So it's a pretty big deal there. They've already moved a lot, but I think it could be decent, especially if we get more volatility in the market. So definitely keep your eyes out for that. That is play number 1. Then play number 2. I'm excited about this one. McDonald's. Yeah, I was going to go for revenge today, believe it or not. I saw them. They were looking quite interesting, but I decided to go with NVIDIA instead because they're kind of lower than where I closed out that one short from a couple of months ago. But the reason why I'm bringing this up here now is the last couple of days, especially even the last week, you've been seeing defensives get the smoke, and it's kind of showing here that if we do get that worse outcome, rate hike odds go crazy, the data goes crazy, and all of that, well, I don't don't think the Dow Jones is going to be safe, and you might watch a cross-asset sell-off. Pretty much everything except the dollar will probably be going down in that instance. So if that's the case, I'm going to be looking for McDonald's for the short side. I have no plays on it now, but I am definitely going to be watching out for them. And then finally, play number 3, Crowd in Palo Alto Networks. Pretty much Palo Alto, they are the sympathy to Crowd. CrowdStrike had earnings today, and why I'm bringing this up is because Dick's Sporting Goods and SC, they had earnings today, and even though we had this big sell-off, even though the rate hike odds were going crazy and all of that, the individual news kept them up, and it shows that it's probably going to be more important. So depending on how tomorrow plays out, depending on the volatility, if there's a lot of smoke everywhere else, this could be a good place to find a safe spot in the sense of just not going too crazy and responding to the news more so than the market. So we've called this out a couple of times, and we've seen this on various earnings plays. So we will see what happens. But those are the main plays. As far as everything else, I made a couple of other ones. I grabbed 100 shares of QUOT, small $3 stock, spent less than $400. They had a rumor or Reuters report that they were getting bought out, had a little pop and halt, then nothing after that. Then UNCY, I sold out of this at like 120% gain. We bought it way back in the day there. Not really way back in the day. This was like a couple of months ago. It was right here before their PDUFA. Then they ended up delaying it and not doing too good. And then 3 months later, they now had the pop. I got out at 190. Very good gain. Can't complain on 1,000 shares. So that one's like still $1,000. Got out of that one. I closed my Okta and AMD. I got shook out a little earlier, and pretty much rate hike odds were at like 50%, and then they climbed up to 60. And I was like, okay, I don't really want to deal with this here. At the very least, I could deal with a loser, and we could balance that out there. But last thing I want is any of these plays that went from red to green. I don't want them to go red again. So sold out of Okta. Took like $500-600 profit. Took another $250 on AMD, and then I opened up the NVIDIA short, and then I added 100 shares of Bank of America at $32.89, and now I have a total of 500 shares, and I'm down about $2 a share on them, but you'll see that right here. So there's the Bank of Americas. Those EPVs did good. We'll jump up here to the ES. The double ES clapped me yesterday. I was going to close out of it, and I thought we could get a little bit more. I was going to close it out for a loss right when the written statements came out. I thought we could kind of finesse it a little bit, but I ended up paying the tag. So yes, I know I said don't get trapped. I got trapped here for a little bit, but thankfully, this one's due to big position sizing. We're not too far away, but going to try to balance it out. Worst case scenario, I end up holding long side by the time the NQ comes up. These plays we're going to be rolling over probably end of this week or middle of next week. Spreads on the next month contracts are still high, and the plan is wait for Powell and data, but both of these are just going to be insane from here on out, and get ready. It's going to be crunch time. Still in the Google, still got gains on that. It's actually been the biggest run-up on Google since 2019, so that was nice. The Amazon, I'm thinking about averaging down. That one's kind of been struggling since we went from green to red. The Tesla from yesterday got murdered, and then the Meta, these ones were down a lot more. They actually were only down like $100 today, so we still got some upside, and they announced like layoff news too. Then still in the EPV, we cut the AMD and the Okta, had a couple of other random plays come back up like Suave, still in that. Then even the Qualcomm came down, and a lot of people were talking about EBS. I'm still holding this one. Remember, we played this one after their Narcan thing. They do have an FDA approval coming up, so still holding that one on 100 shares. Again, smaller share price, so that loss, it's $500, but it's a lot bigger percentage-wise, but still holding that one out, and then really riding out everything we said we were going to be watching. Maybe take a McDonald's short, but overall, I think these data events are either going to get us good opportunities to get out. Maybe they trap us, but point is, volatility is about to go insane, Chad. So I hope you're ready. But that is your watch list, ladies and gentlemen. Make sure hydrate, healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. I need you to remember, baby, thoughts and feelings are not senses. You got to use all of your senses. Make sure you're looking. Make sure you're listening. And you might realize that you have a way better environment around you and way more opportunity than you initially thought. But Chad, it is there. Your senses, your knowledge, and all of it being well-rounded will take you to the finish line. Like I've been telling you the last 3 months, it's only the beginning, baby. So I hope you got the stamina, and let's bring it into the close of the quarter, Chad. But I love you. Drink that water. Stay healthy. Stay hydrated. All of that. And shout out the real ones, and thank you for always holding it down, baby. I'll see you in the morning. Horn.